Welcome to Morphic Labs, and today we are going to be discussing the retail quant structural edge, a mathematical analysis of the capacity constraint and the nimble trade advantage. But before we get into that, do me a favor, hit the subscribe button if you're interested in increasing your market intelligence. I have a free market microstructure and trading systems course, plus an advanced market aggregation course. The links in the description. You just gotta sign up to be a free member, and you'll have them both to yourself. Now let's get into it. Today I'm just going to be touching on chapter 1 up until 3, the capacity constraint paradox, market impact and slippage, a mathematical model, the scale penalty, institutional versus retail. The quantitative trading landscape presents a striking paradox. The most well-resourced participants are structurally disadvantaged in the most profitable strategies. Institutional funds managing billions in assets face constraints that render entire categories of high-return strategies economically infeasible, while individual retail quants operating with capital between 10,000 and a million enjoy a remarkable structural edge. This document provides a rigorous mathematical treatment of the capacity constraint problem, demonstrating why the retail quant's defining edge is not speed, information, or capital, but rather market invisibility. Now, what is capacity constraint? Now, here's the definition. The maximum amount of capital that can be deployed into a trading strategy before the strategy's execution costs, market impact, slippage, and opportunity cost of liquidity exceed its expected alpha, rendering it unprofitable. Consider a strategy generating an expected return mu per trade with a Sharpe ratio S. As capital A increases, the per trade profit does not scale linearly. Instead, the realized return follows mu cap E of A equals sigma sub 0 minus C sub I times I of A minus C sub S times S of A minus C sub O times O of A, where I of A is the market impact cost function, S of A is the slippage function, O of A is the opportunity cost of liquidity, and C sub A, C sub S, and C sub 0 are respective cost coefficients. The critical threshold A star occurs when mu cap E of A star equals 0. Market impact and slippage, a mathematical model. The square root law of market impact. The relationship between order size and market impact has been extensively studied in market microstructure literature. The canonical model verified across numerous asset classes follows the square root law, defined as I of Q equals eta times sigma times Q over V raised to gamma, where I of Q is the temporary market impact in basis points. Eta is a market-specific constant. Sigma is the daily volatility, and Q is the order quantity. V is the average daily volume, and gamma is 0.5 for most liquid assets, empirically found in the range 0.4, 0.6 in this open interval. Closed interval. Table 1. Square root impact parameters by asset class. Asset class, we have eta, we have gamma, and we have sigma as our columns. Large cap equities S&P, mid cap equities also 2000, small cap equities Forex, major periods, cryptocurrency, BTC, Ethereum, alternative coins, niche crypto. As you can see, they have an eta of 1. The first asset class has a eta of 1.5 to 3. The second one is a 2.5 to 5. The third one is a 5 to 12. The fourth has a 0.8 to 1.5. The fifth has a 3.0 to 8, and the last one has a 10 to 50. And the gamma is, the first one 0.45 to 55, the second one 0.50 to 0.65, the third one 0.55 to 0.70, the fourth one 0.40 to 0.50, the fifth one 0.50 to 0.70, and the sixth one 0.60 to 0.85. And the daily volatility is about 15% to 25%. The second one is 25% to 40%. The third one 35% to 60%. The fourth one 8% to 12%. Fifth one 50% to 90%. This shouldn't surprise anybody. Everybody knows cryptos are very volatile. And the last one 80 to 200%. These are niche alternative coins. 2.2. Slippage as a function of position size. Slippage, the difference between expected execution price and actual fill price, escalates dramatically with position size. For a limit order at price P sub limit, the realized slippage can be modeled as slippage of Q equals Q over Q plus Q sub depth times spread over 2 plus alpha times I of Q. where Q sub depth is the order book depth at the best bid and ask, and alpha captures the fraction of temporary impact that persists into the execution price, right? So essentially, the smaller Q is, right, the smaller the order quantity is, the less slippage there is. So if you're pushing a big Q into that slippage function, just expect that you're going to have a very large slippage, right? But if you're pushing a small Q or at least a moderate Q, the slippage shouldn't be that bad. Number 3, the scale penalty, institutional versus retail. Critical insight. For a retail trader with Q sub retail much less than Q sub depth, slippage approaches about spread divided by 2. For an institution with a Q sub inst much greater than Q sub depth, slippage becomes approximately I of Q sub inst, which can exceed 50 to 100 basis points. Order size discrepancies. The quantitative divergence between institutional and retail trading profiles is stark. The following tables present the numerical reality of the capacity constraint. Table 2. Typical order sizes, institutional versus retail quant. Here are our columns. We have metric, we have retail quant, we have small institution, large institution, and the ratio between the institutional value and the retail value. Now, AUM is assets under management, and we have average position size, average order size, percentage of average daily volume, and tick size impact. For a retail trader, when we look at his metrics, or a retail trader's metrics, you can see that they have about 10K to a million under management, on average at least. They have average position of 500 to 50,000, average order size of 100 to 10,000, and average daily volume of about 0.001 to 0.1%. And tick size impact of our orders is about 1 tick, or at least less than 1 tick. Small institution, they have about an asset under management of about 50 million to 500 million. Average position size about 250K to 5 million. Average order size of about 50K to 1 million. And the average daily volume is about 1% to 10%. And the tick size impact is 1 to 10 ticks. Large institutions have about 1 billion to 50 billion of assets under management. The average position size is about 10 million to 500 million. Average order size is about 2 million to 100 million. And the average daily volume is about 10% to 100% plus. The tick size impact is 10 to 100 ticks. And the ratio between the institutional value and the retail value given the assets under management is about 50 to 5 million X, right? And for the average position size, it's about 200X to a million X. For the average order size, it's about 200X to 1 million X. And for average daily volume, it's about 100X to 100,000X. And tick size impact about 10X to 100. So they essentially have about 10X and 100X more tick size impact, because as a retail quant, we usually have about less than 1 tick impact, if that, nothing, right? Table 3, bucket impact cost comparison in basis points, right? Asset class, we have S&P 500 large cap, we have Russell 2000 mid cap, we have small cap equity, niche crypto pair, and then options chain. And we have retail with 1 BPS, retail with 10 BPS, retail with 50 BPS, and institution with 500 BPS, and institution with 5,000 BPS. And as you can see, a retail at the S&P 500 has about 0.01, right? And at Russell 200, we have about 0.02. At small cap equity, we have a 0.05. Niche crypto, we have about 0.50. And then options chain about 1, right? Retail 10 BPS about 0.03 with the S&P, 0.07 with Russell 2000, 0.16 small cap equity, 1.50 with niche crypto pair, and about 3.60 with thin options chains. Retail with 50 BPS about 0.07, 0.16, 0.35, 3.54, and 7.07, right? Institution with the 500 BPS is about 0.22, 0.50, 1.12, 11.18, 22.36. And as you can see, when it comes to these more niche markets like crypto, niche crypto pairs or thin options chains, these institutions have crazy market impact. And institution, 5,000 bps is about 0.71 on the S&P, which is really crazy because when you look at a retail with 1 bps, just 0.01. And then we have 1.58, 3.54, 35.36, and 70.71. Note, values represent estimated temporary market impact in basis points using the square root model with gamma equals 0.5. Position size, retail 1 bps equals 100, retail 10 bps equals 10,000, retail 50 bps equals 50,000, institution 500 bps equals 500,000. This isn't really, I should have put some spaces there, but whatever, this document is not for sale. So yeah, institution 5,000 bps equals 5 million. The liquidity trap. Large funds face a liquidity trap. They are mathematically constrained to trade only the most liquid instruments, leaving vast swaths of the market effectively inaccessible. Table 4, tradable universe minimum average daily volume requirements. And this is our fund asset under management column. We have the max single position sticking to 2%, minimum average daily volume required 10% roll, and the tradable universe that's open to you given your assets under management. Now with $100,000, you have a max single position of 2,000, a minimum average daily volume of about $2,000, and a tradable universe of about 15,000 plus US equities and all liquid crypto. At $1 million under management, you have about a max single position of 20,000, and you have a minimum average daily volume of about 200,000, and you have a tradable universe of 8,000 plus US equities and the top 200 cryptos. At $10 million under management, you have a max single position of 200,000. You have a minimum average daily volume of 2 million, and you have a tradable universe of approximately 3,000 US equities and the top 50 cryptos. At 100 million assets under management, you have a max single position of 2 million, and you have a minimum average daily volume of about 20 million, and you have a tradable universe of about 500 US equities and top 10 crypto. At $1 billion under management, you have about $20 million as a max single position, and your minimum average daily volume required is about 200 million, and your tradable universe top from 500 US equities, top 10 crypto to only 100 US equities, Bitcoin, Ethereum only, right? Because these are essentially less volatile than the cheaper, more lower end cryptos. And at 10 billion AUM, you have a max single position of about 200 million, a minimum average daily volume of about 2 billion, and you have a tradable universe of only 30 mega caps and Bitcoin only. You could put Ethereum in there, but you approximately have about 30 mega caps and Bitcoin only, which means that as you increase your assets under management, you decrease your tradable universe. So that the number of possible tradable universes drops significantly as you increase your assets under management, which for us retailers is amazing because we know that we have about 15,000 US equities and all the liquid crypto to exploit, and an institution with about $10 billion under management has about 30 mega caps and maybe Bitcoin sometimes. We essentially have a higher number of possible tradable universes, which gives us a sort of a higher opportunity in terms of just pure execution than, say, an institution with $10 billion. Proposition 3.1, liquidity exclusion principle. For a fund with assets under management A deploying positions no longer than fraction F of assets under management and requiring that any position represents at most fraction phi of the asset's average daily volume, the fraction of tradable assets with daily volume V satisfies V is greater than or equal than F times A over phi, with F equals 0.02, 2% max position, and phi equals 0.10, 10% of average daily volume. A $10 billion fund can only trade assets with a volume of about $2 million per day, right? A 100K retail account can trade assets with V greater than or equal than 20 per day, right? Excuse the rendering. This document is not really for sale, so it really doesn't matter. It was just a quick little setup to really explore the idea of the retail quant's edge. 3.3 Execution speed and detection. Execution time introduces another critical divergence. Large orders require algorithmic execution over extended periods, exposing the institution to alpha decay and predatory trading. Table 5 Execution time and detection profile. Here's our columns: metric, retail quant, small institution, large institution, right? And as you can see, we have typical fill time, execution method, order book footprint, alpha decay risk, predatory HFT risk, and information leakage. Now, for a retail quant, our typical fill time is about 1 millisecond to 1 second, right? And our execution method is either a market order or limit order. Our order book footprint, little to none. Our alpha decay risk, negligible. You can just act like it doesn't even exist. Predatory HFT risk, none. Information leakage, none. For a small institution, their typical fill time is about 1 minute to 1 hour. The execution method, TWEB/VWEB. Order book footprint, they are detectable. Their alpha decay risk is moderate. Their predatory HFT risk is low. Their information leakage is minimal. Large institution, their typical fill time is about 1 hour to 2 weeks. The execution method, custom viewer plus dark pools. Order book footprint, high visibility. Their alpha decay risk severe. Their predatory HFT risk high. Information leakage extreme, especially if they're having a permanent impact on the markets. Table 6 Time-based cost attribution, BPS per day. And we have 4 columns: holding period, retail cost, institutional cost, and differential. And if you have a holding period of intraday less than 1 hour, the retail cost is about 0.5 to 2 basis points, not crazy. Short term, 1 to 5 days is about 2 to 10 basis points for a retail. Medium term, 1 to 4 weeks of holdings, about 10 to 50. Long term holding, 1 to 6 months, about 50 to 200. Institutional cost for intraday less than 1 hour is about 5 to 50. Short term, 1 to 5 days for institution is about 2.150. Medium term, 1 to 4 weeks for institution is about 100 to 500. Long term, 1 to 6 months for institution is about 500 to 2,000. And it's a differential of 10x to 25x compared to the retail's intraday cost, right? Time-based cost attribution. And the differential for short term, 1 to 5 days, retail versus institution is about 10x to 15x. Medium term, 1 to 4 weeks, institution versus retail, about 10x more. And long term, 1 to 6 months, retail versus institution, about 10x more. But that's about it for today. On the next video, we're going to be talking about the retail opportunity space, or the opportunity geometry. But that's about it for today. If you're interested in increasing your market intelligence, I have a free market microstructure and trading systems course plus an advanced market aggregation course. The links in the description. You can get both of them basically for free if you sign up to be a member, and hit the subscribe button if you want to keep up with more content like this. And I am out.